now that you all know everything you need to know about Tyler, including his favorite color and that unicorns are real, we will get right to it.
It's the only one I could think of.
Right. Well, it's
I should have said Bigfoot, because we're in Bigfoot country. But
and like, you don't have to twist my arm that much. Like, I will say, so I also work in the field of orthotics and prosthetics, so that's what I do Tuesday through Friday, because I love to be busy, I guess. Anyways, one of my patients is a legitimate Bigfoot hunter who, like, he's been on some of the, like, TV shows or whatever, so I got to write in a chart note, patient's primary hobbies are Bigfoot hunting. I was like, I've peaked. It's not going to get better. Like, this is great.
Well, so, I lost my leg because a Bigfoot ate it.
See? Yeah, there we go. So that was, a bonding point for us when we were talking. We're like, oh my gosh, we know about each other's worlds in that sense with prosthetics. So anyways, let's dive into our conversation here. So just give us kind of your elevator pitch on venture capital, specifically from the investor's point of view. So like, basically just give us the basics. What is venture capital?
Yeah, sure. So venture capital, it's nothing like mystical about it, really. It's people that have a pool of money that want to get a return, and so they are not risk averse. They're open to having a lot of risk to get really high returns, and so their whole goal is to take this pool of money and put it in businesses that will give them way above average returns compared to what you would normally get in other investment opportunities.
Yeah. One of the things I like to think about too with venture capital is the point of venture capital is to invest. Like, they are actively looking.
That's all they are, yeah.
Yeah.
Every venture capitalist just says, I'm an investor. They don't go say, I'm a venture capitalist.
Right.
If they do, they're just trying to win favor of someone.
Right. Or get all the deals through like LinkedIn when it's like you go and scan. So excellent. So with that, you're normally looking then for, is there a certain percentage that you're like, oh, like this is the gain I'm wanting to get off of
Most
deals?
venture capitalists are going to look for a 10x return.
Mm-hmm.
So if they put in 100,000, they're going to want to get $1 million.
Mm-hmm. Absolutely.
And then you hear of the unicorns where they put in $1 million and get $1 billion type thing.
So I mean, I guess in some ways unicorns are real.
Yeah.
Honestly,
as a venture capitalist, the unicorn is our mystical creature that we're looking for.
So what are some key things that, say, venture capitalists are looking at when a founder or a startup company comes to them? Like, what are some key indicators that you're like, oh yeah, I would give you a second interview, or I want to pursue getting to know this opportunity more?
Yeah, sure. So, I mean, I kind of alluded to it, they're looking for a return. So more importantly, they're going to look at the business from a standpoint of, can I make a return on this, and how big of a return? And if they don't think it's a 10x return or greater, they're not going to invest. And venture capitalists, like, just to give you an idea, they'll invest in 100 companies, and 90 of those will flop. And so they're expecting out of that 10 to get 10x returns, and out of that 10, like, all those tend to get 10x returns, and hopefully one or two of them will get 100x or a much higher multiple than 10. And so that's the number one thing, is you have to think in their mindset of why are they going to put money in my company? It's because they want to get a 10x return or higher. But the other thing about venture capitalists, it's just like everything else, it's relationship based. As much as nobody talks about that aspect of venture capital, they're like, you have to have your deck right, you got to know your TAM, you got to know all these like analytical pieces of your business. That's part of it, but it's really about how you develop a relationship with the venture capitalists that are going to invest in your company.
Has there been any, or like just from your time in that world, any particular standout founders that like they pitched and you're like, take all my money? Like that, can you like tell us about anyone that really stood out to you in a positive sense?
Yeah, I mean, multiple. I mean, the ones we invested in, they were 100%. It was about the founder more than the business. And so you understand that every business on paper, like you have a deck, they might even have customers, they might even have revenue. At that point, it's just a snapshot of that business. And going forward, that business is going to hit a gazillion challenges, have to go over mountains, through valleys, and they're going to be very lucky to survive. And so you're investing in the founder that you think can navigate those challenges and the turmoils of of running a startup.
Yeah, there are ups and downs, which is a part of why Startup Reading exists, to be with you on all of those things. So as a founder, I'm getting prepared for my first, hypothetically, I'm getting prepared for my first meeting with a venture capitalist. What should I expect in maybe those initial meetings, or is there anything in particular that I should prepare?
Well, the first thing you should do is read a book called Pitch Anything by Oren Klaff. It's the most realistic book out there on pitching venture capitalists. And because Oren has actually done it and does it for startups, he gives you the blueprint on how to do it. And what you're going to learn in that book is how to tell a story about your business. And you want to tell a story in a way that, one, shows them that you're going to get a 10x plus return, but two, in a way that if they don't invest now, it's too late. Like the train's leaving the building, and you kind of got to give them that FOMO of like, hey, if you're not going to invest, then all right, cool. I got a bunch of other investors, and good luck. Sorry you're going to miss out on these returns. And so, and it's about developing that relationship with them when you do that.
Were you ever on the other side of FOMO where you're like, oh, I wish I could have, I should have acted on that one?
Well, yeah, I mean, everybody is like in that industry. And there's sometimes it just like we'll see phenomenal companies. And this is a point I want you guys to understand. If they don't invest, it's not personal, usually. Like 99.9% of the time, it's not personal. We had a very specific thesis in what we invested in, and we would see phenomenal companies, and we just wouldn't invest in them because it didn't follow our thesis. And so that's one of the things you want to prepare for. When you go to talk to investors, make sure they actually invest in the type of business that you have, because you're really wasting both of your time, unless you're just there to get their advice.
Yeah. I got coffee with someone this morning who they're working with someone on kind of a part of a startup. In the last month and a half, they pitched 150 VC firms, and I think maybe one or two people were like, yeah, we'll do a second one. But like this guy literally has had 2 exits. One was an 8-figure exit that he exited from, so like he has a history that has been successful, and he's still 150 of them, and he's like, oh, it's just a numbers game, like whatever.
Yeah, so. I mean, story after story, I go to a lot of like networking events with entrepreneurs and investors, and a friend who's a venture capitalist now who was a founder, he did 73 investor meetings before he got his first check. Yeah. And then did, I think, 40 or 50 more before he got his second check. And he did the due diligence too. It wasn't like he just called up everybody. So it's a lot of work, and you gotta be willing to just persist and keep going.
It's a numbers game.
Numbers game.
Yeah.
It's like meeting, a spouse.
It's a numbers game, So I'll just say to Eric next time, it's a numbers game. I don't know. So better luck next time. So with that, from now the founder side of things, like, are there good questions to say ask VCs? So either you know what you're getting into, or VCs are like, oh, that was a very inquisitive question you asked. Like,
yeah, and it's going to depend on the stage of the relationship with the VC. Like on first meetings, you can understand. I mean, the initial questions you're going to be asked, like what. Before you get started, if it's not clear on their website or through conversations had what they really invest in, maybe clarify what they invest in. A good question to ask what they've invested in previously, and specifically the partner or the person you're talking to, like who have they found, what have they invested in, so you can kind of gauge how you want to position your business in front of them. Like I said, it's relationship based, so you want to get to know them as much as they're trying to get to know you. Because the other thing, too, is this is a marriage. It's not, hey, like, I got a check, and now I get to go spend money, and they're never going to call me. No, they're going to call you a lot, and they're going to be very involved in your life, and they're going to have control, like some aspect of control of your company based on the terms. And I know we're going to talk about that in a bit. So
you probably shouldn't tell them, it's a numbers game. Yeah, figure it out. They
know it's a numbers game.
Right. So with that, when, let's say that we've gotten to that point where it's like, yeah, like let's do this thing. Like, let's get this check written and move forward in this relationship. Are there any particular red flags that founders should look at or be aware of when it comes to the term sheet?
Yeah. So you want to understand the control that they're getting from the term sheet and what those terms mean. A lot of founders, like you're 63, 64, 65, like conversations in, you haven't got a check, and all of a sudden someone's going to write you a check, and you're just like, I don't even care about the terms. I just want that check. And then you get 2 years down the road, and you're like, you walk into a meeting, and they're like, hey, thank you for all your service. Here's your walking papers. We now own your company. And you're like, what? Because you didn't check those terms. A lot of times, you're going to get term sheets that just aren't going to make sense. And you can feel free to try to negotiate that term sheet. And if you don't get a rosy, like, butterfly feeling in your stomach of like, hey, I want to do this, don't do it. Like, trust your gut on that, because it's not worth it. This is your passion. This is really what you want to build. It's not worth giving up your business for a few dollars. And in the end, if it's going to be a successful company, it really is just a few dollars. Yeah.
Well, that segues great into our next question is, outside of the money factor, how do you know when it's a good fit? Kind of from both perspectives.
So you're going to want to talk to other founders that have worked with the venture capital firm, specifically that partner. A lot of times the partner that's going to be your advocate within the firm is going to be the one that sits on your board. So you're going to have to understand, is that person someone that plays well in the sandbox? Are they going to be a good board member, or are they going to be a bad board member? I actually got into the venture capital industry because of bad board members. And
that you personally experienced?
Well, I was. That's how our firm kind of got created. Was my buddy's a longtime venture capitalist. There was a scenario with this really cool company, phenomenal company. They had deals, the licensing deal with Apple. Mm-hmm. They were going to get distributed in like 100 Apple stores with their product. And then there was just some really bad board members. So they had asked my partner to come in and say, hey, can you be a white knight and come in and help save our company and balance out these bad board members? And in doing so, he had to bring $2 million investment. And so
that's an ask.
Yeah, and so we hadn't created our firm yet, but he and I went out and raised the $2 million in 7 days. And in the end, we actually didn't invest it because the board was so bad. Oof. And we couldn't in good faith give the investors money to that company because we knew how bad the situation was on the board once we dove in and did our due diligence, and the company folded. And it was a phenomenal company with rock star founders, and unfortunately, that's the way it ended. Yeah.
So kind of from the founder's perspective as well, is there anything that you're maybe looking for? Is it just basic human relationship? Like, it's like, I think that this person, like, gut check feels good, or is there
gut check, but do your due diligence on them. They're doing all their due diligence on you. They're going to look at your personal history, your career history, your resume. And they're going to be talking to people about you. You need to be doing the same. Just go out and find as much information about them as possible. And there's like Angie's or Angel List and some other places you can find out who they've invested in the past. Reach out and just ask them too, like, hey, what companies do you sit on the board of, and can I talk to the CEOs? Because you're interviewing them as much as they're interviewing you.
Yeah. So let me see your references real quick.
Yeah, seriously.
Yeah.
Like I said, you're getting married. So,
Absolutely.
And the worst part is they actually can take control a lot of times.
It's like these questions that are coming up. It's so good.
I don't know.
So, right? Crazy. So what are the hidden costs of venture capital? What can happen when you take it? Like, normally you're giving them a board seat, but like, what else are kind of the hidden costs if that's an impact culturally, business model wise, things of that nature?
Yeah. So, I mean, venture capitalists, like, again, it really depends on the person that ends up on your board and the relationship you have with them. If it's not a great relationship, well, let's not even go there. Just in general, you're going to have more stress because you have another body that you have to answer to. So every check you take is a new board member for the most part from a venture capital standpoint. I'm not talking about angel investing. I'm talking about venture investing. And so if you take 3 checks or 4 checks, that's 3 or 4 board members that you have to answer to on a weekly, sometimes daily, usually weekly, monthly basis, definitely quarterly And so these are stresses you're going to have on top of the gazillion challenges that you deal on a day-to-day basis with.
What's the largest board you've seen?
Well, I've seen up to 12 board members.
Okay.
Which is really high, but it's really kind of that's more interesting. But like you can, it just depends. It just depends on the structure of the company, how big the company is, things of that nature.
Totally. So like how can founders ensure kind of that long-term alignment between like maybe the venture capital firm or that, VC officers like, oh, we have to push and get all these crazy gains. And they're like, whoa, we need to grow conservatively. Like what would you say to that? Like aligning those goals?
So a lot of those milestones and the challenges they give you are ways that are things you're going to have to hit in order to get more funding. Because most of the time you're not going to get a check that just gives you the run rate that you need. And so it's going to get you to a point of your company, and then you're going to have to go fundraise to get to that next point. And so that's why those milestones are there, and that's why that pressure's there. And you have to kind of, that's the thing, is when you're signing on an investor, you have to understand what their expectations are, and if you can meet those expectations, because that's going to be part of the term sheet a lot of time, or at least maybe not actually in the term sheet, but it's the contract you're coming together with them. And so you need to understand, am I going to be able to meet those milestones? And if not, that's where pivoting comes in a lot of times too. You hear about pivoting, and
we've heard about it once or twice. Yeah, far off in the ether somewhere.
Yeah, it happens like in every business.
Yeah. So what are the implications of VC funding in future rounds? So basically, like how should founders plan for that in the future? It's like, oh, maybe in this, let's say it's a Series A, like I want 3 VC funders. So that way I have more board seats or what have you for future rounds. Or is there any strategy to that? Like if you know you're going to fund more?
It's more of an art than it is a science, because when you're first starting out, you're trying to get, most people are going to get like family money, friends and family, or angel investors. You're not going to have a lot of stuff tied to that. It's just going to be like, hey, we kind of like you, so we're going to give you some money, and hopefully you make it some money down the road.
Fingers crossed. Yeah.
And then you go get your like A round or seed round. You start getting venture capitalists involved. It's so funny, like the rounds have shifted so many times over the last decade. But like then you're going to get a round where VCs are involved. Well, now you have what's called follow-on investors. You have to worry about a lot of those people that invested before. If they don't come back in, they're going to get what's called squeezed down to common. Because when they invest, they get preferred stock. There's 2 levels of stock, preferred and common. So they're going to get common, which means they don't have any voting rights. They're just now a shareholder. Mm-hmm. Preferred is the people with voting rights that can make the decisions for the company. And so every time you get around, that preferred stock like group is going to change. And the ones that come in with the big money, they're the ones that are going to control your company. And if the other investors that came in before don't pony up more to meet that, they're going to get squeezed down to common, and they're not going to be able to help you or have any type of say in how the company's run.
Totally. So what's like the most common exit strategy that you see in like VC deals? Like how does the VC get paid?
Well, I mean, when the company sells, and so that's, or goes public, and which is a sell. You're just selling to the public, essentially. And so right now you're seeing a lot of PE deals where private equity is coming in and they're buying up companies. You have a few IPOs out there, but majority are acquisitions by a competitor or someone who can take advantage of the business and to help grow so a larger corporation will come in and buy the startup.
Yeah. So 2 more questions here, then we'll turn it all over to you guys for just open Q&A, okay? So you can start thinking about those questions. So if someone's like, I have no interest in going IPO, I don't want to sell my company, is that a VC fit? Or if someone's thinking that, you're like,
you're not going to get VC. Because they're there for the exit. And they're actually going to evaluate you on how they think you can exit. And they're going to ask you, how do you think you can exit? And a lot of times if you answer that question wrong, you're not going to get venture capital.
They're like,
Yeah.
Sorry, next.
Yeah.
So the burning question is, what's the most memorable pitch you've heard? Or like, what's one of the most standout things? Like with the Angels, I unfortunately missed this one. But they had this crazy one, Sammy can tell you about it, where it was like a lightsaber boring, like not boring, but like digging into the earth boring system. And it was like lightsabers that it could do all sorts of different shapes. And like, it was so cool. I mean, you guys still talk about that, and that was years ago.
Was that GA drilling?
No, it's I'm not good on the spot.
Yeah.
Okay, it doesn't matter. Well,
But it was cool. He saw the pitch and like, yeah.
I have a friend that owns a company like that, so that's why.
Earth Grid.
Oh, okay.
Yeah.
Yeah, I
so-
know a company that does plasma drilling, and then like
So cool.
Yeah.
Yeah.
They use
Yeah, I
that.
like to call it lightsabers. Yeah. So, but anyway, so what is like the most memorable pitch you've heard?
It was probably this first one. So it was a company that they were called Mark One, and they had a cup, and you could put whatever in the cup, and it knew what it was. And so you could put a beer in the cup, and it would know it was a beer. It knew exactly how many calories, carbohydrates, stuff like that. It was really cool, and that was the one that shut down.
Oh no.
Like the one that had to deal with Apple.
Yeah. That's cool though.
Yeah.
Did it like
So-
keep things warm or cold? It was just like,
No,
no,
it was-
this is what
it
it
was
is. Here's
there
the
to
calorie.
it was a fitness basically cup.
Oh, okay,
So it was
okay.
there to track hydration. Like it would keep track of how many fluid ounces, like what you drank
Yeah.
throughout the day. So essentially,
Cool.
you would have had to pour everything in that cup, and they would have created other iterations down the road
Yeah.
and stuff. But it was
That's
really
neat.
cool.
I already know I'm underhydrated, so it's fine.
Yeah.
Whatever. So
That's a fun one that everybody can associate.
yeah.
With. I've seen some really nerdy stuff that
What's
we
like
got
some
excited
fun nerdy
about,
stuff?
I don't know. I mean, one of them was it was just some AI and machine learning type stuff.
And that was before AI was cool, right?
yeah. This
Yeah.
is before ChatGPT and all.
Mhm.
This was 8-9 years ago type thing.
Mhm.
Well, no, this was 2018, so 6 years ago, almost. But the I mean, so this company's really cool. They use AI, machine learning, and to actually grow food. So it knows exactly how much sunlight, how much nutrients, how much water to give like food, like to give produce, so that it
Cool.
grows the most optimally, whether it's in ground or in like a hydroponic type of setting or whatever.
Neat. So it's not like it was necessarily a self-contained thing. It was just like, oh, here we can tell you like how much more water this soil needs or that soil needs.
Yeah, I mean it's specifically for plant by plant. And
Now that is something I would use. I have killed so many plants.
Yeah.
It's pathetic. A patient gave one to me last week. It's already dead.
I'm the-
So it didn't help.
they die when they enter my house.
yeah.
it's like, we already know we're just
We're
gonna.
like, we know how this story's gonna
We're
go.
gonna unlive ourselves right now.
Right. It didn't help. I did leave mine in the car for 2 days. And I was
Yeah.
like, oh, baby, I forgot about you. I'm so sorry. I was
Yeah,
like,
it was-
here's some water. Are you happy? And it's like, no. So, yeah, I wish that it was safe.
Don't
That
leave
one
it in the
took
car
off. Like, yeah, give me their thing 'cause I need that. So, anyway, the floor is open to you guys. If you have any questions, you are more than welcome to fire away. I will give you the microphone. So, who wants questions? Okay.
I'm wondering how far along would you recommend someone's business is before you go for VC funding? Like when is it you're ready?
So it's going to be dependent on the type of business. If it's a capital-intensive business where you need a lot of capital to even get going, usually that's something where hardware is involved. You have to actually physically build something. You're going to want to go really early into it. Probably after you've created a prototype, if you can, unless you're some kind of scientist and it's something really crazy and you're just going to need money to do it. If you're software or service-based and things like that, then go out and get customers and then go do it. Because the day of like, hey, this is a slide deck with an idea and they get millions of funding is not, like you hear about those stories, like, but they don't happen very often nowadays.
What is the ideal percentage of equity from the entrepreneur's perspective that you would recommend that we go for? Because like you said, some people get eager and they're just like, yeah, give me the money, and they give away the company. So from a calm, positive perspective, what percentage should the entrepreneur retain and what percentage should the VC have, you think?
Whatever you're comfortable with.
49%?
Never above 50 if
Yeah.
you really want to maintain control.
Yeah.
It can be hard because you got to realize, you got to look at it from if I have to go get more money, how am I going to, because everyone's going to get squeezed out anyways,
Yeah.
because you're essentially going to add more shares, and so your percentage of equity is going to go down
Yeah.
per round, including the founders.
Right.
And so it depends on what round and all that stuff. But
Got it.
yeah,
Okay.
early
Yeah.
investors get more because they're putting up more risk. But
Right. Just to clarify, you said it's for each round, the initial investors get squeezed down to common stock unless they invest again in that round. So they have to invest in every round to maintain
usually,
that preferred stock.
yeah, usually.
Okay. Awesome. Thanks.
Yeah.
That was a really good question. So mine's more about nonprofit. So obviously it wouldn't be the same type of, raising funds. But I was curious, just being that you're in the field, if there's anything that I could consider other than grants and people wanting tax write-offs and things like that.
You got to understand, very wealthy people are very generous people. They got there because they're generous, not because they're stingy. And so it's like go create relationships with very wealthy people and do research and find out if they have a tie to the cause that you want to raise for.
What, with your expertise, is the current state of venture capital now with everything going on in the tech ecosystem and this year?
Yes, that's a great question. I'm going to answer based on some just anecdotal stuff that I see being in the Valley and like just having friends that are in the industry. It's a really tough time for venture capitalists right now because money is just sitting on the sidelines. There's a few things getting funded like AI. There's some biotech, some pharma stuff, but right now it's like venture capitalists. So I don't know if you guys know, but like venture capitalists, they get money from high net worth people and institutional investors, which are big companies that want a more high risk, high earning type of investment. And then you have like what's called fund of funds, which are venture funds that raise money to invest in other venture funds. Like all that money is like tight right now, so it's not getting flowed down to the venture capital firms. So it makes it being a founder really hard right now too.
So piggybacking on the question, so if I can't get VC money, I try to get private equity. What's the pros and cons of private equity over VC?
So private equity typically works different than VC because private equity is usually going in to operate the business, where venture capital is there as like to invest in the business and then provide guidance. And so some PE firms, and I'm doing very generic terms, like I know PE that does more like venture type stuff. It's just going to be depending on the private equity firm and how they invest the money, really. Like what kind of control are they going to want? Are they going to want to put their own operators in the business? Things of that nature. Like venture capitalists are fairly hands off. They might insert like an executive just to kind of watch over you if they're like a big leader in the round, but private equity may want to come in and actually start running the company, so it just depends on the company. Great question, though.
I have a question about, I guess, communication. So, like, I have worked with a lot of nonprofits or grant-funded organizations, and sometimes stipulated in the grant, it'll be like you have to do the X kind of marketing or like tell your story in this kind of way that makes us look good as a foundation. Is there anything similar in VC, or is it kind of like we don't want flying under the radar?
No, there's nothing like most of them are kind of behind the scenes,
and they're happy to stay that way.
They only come out when you've made a big exit. And they want to.
Yeah.
They want to brag.
Totally.
Then they'll put their name on it. Yeah, exactly.
Hi, I was wondering, so as a VC investor, are there certain company fundamentals that you're looking for when you're thinking that this company might actually hit those marks of 10x scale? And has those fundamentals actually changed with the changing tech ecosystems and the tech landscapes?
That is a phenomenal question. So the fundamentals are the fundamentals of any business, right? Like we want to bring in more revenue than you're gonna want to put out, but it depends on the type of business. In the tech world, I mean, if you learn about Amazon, I don't know how many years they went with running in the negative. And so it's really them understanding how far you're going to have to go and really how many customers and that you're going to need to get before you hit the hockey stick, where like all of a sudden your revenues are going through the roof and whatnot. And so the fundamentals are always there. You have to be going to where you're going to make more money than you are spending money. And you're going to have to do that as a function of, for every dollar I put in marketing, I'm getting a dollar plus X back. And then that the greater that X, the more likely they're going to get a great investment. There are some outliers to that. Like, that's what you always want to strive for. There are some outliers where it's like, hey, if I go get X number of customers, I know this large company is going to come after me and acquire me. And so I'm going to get an exit before I ever make a single dollar. But that's not what you should be striving for. That's like, hey, you just hit the right market at the right time, and some big corporation needed that. So they came and bought you instead of building it themselves.
Other questions? Looking for hands. Back to you, David.
So you told the story about having the bad board members and an excellent product, excellent founder. How can we prevent having bad board members?
Don't accept their term sheets.
So it's the bad board member from the bad terms, or from like the bad psychology and heart of these other VCs?
Yeah, it's just they didn't do the research and find out how that person acted on other boards, and if they were an overall person that they wanted to do business with.
Nice.
So,
Do the
yeah.
Do the
What's
res-
that?
Could have been avoidable.
Yeah, but there's a million ways to kill a business, and that's just one of them.
So just do good research on the board members before you sign the terms.
100%. Find out who's going to, like, when you're working with a venture capital firm, you're going to want to find out who's going to be, if you choose their terms and they invest, who's going to be on the board, and then just interview them just like you would anyone else.
Yeah.
Yeah.
Awesome. Thank you.
I have a question.
Oh, okay.
I
There
guess.
you go. You're cute. You can ask.
Thank you. So you talked about a resume and a VC analyzing a founder's resume. If you are someone who hasn't had the traditional resume of maybe being in tech right out of college, going to Harvard or an Ivy League school, something like that, what do you think is a good route to either show that resume or build the appropriate resume to be viable for a VC's attention?
Yeah, I mean, I wouldn't put too much emphasis on the resume, to be honest. I know a lot of people that have built some really cool companies that do not have your typical resume. And I think it's really more about, if you don't have the resume, if you're a first-time founder and you don't have the resume that someone would just go, wow, I understand why you're a founder, go find people, like really good people, like surround yourself with really, really smart people that have done it before. Put them as advisors and as executives on your team. And then, because now you're not selling yourself, you're selling the team, and we're the team that's going to get it done versus I'm the person that's going to get it done. And that's highly effective.
So it's kind of twofold. You said that it's really the idea that the investor wants to know that they're going to get a real ROI on the idea, but then it's also the person. So I was curious if you go more into, is that like 50-50, 75-25 in terms of the percentage that you would say, obviously it's art, like you said, and not a science. But yeah, so I guess that's the first question.
I'll answer, and normally it's going to be, if I had to put a number on it, just off the top of my head, it'd be 80% the team or the individual, 20% the actual business product, because it's going to be that team and that person navigating the challenges of running a startup to profitability or to an exit, because it's likely they may have to pivot once, twice, 3 times before they ever get there. So that business, the way it started, looks way different than that business that exited. And a good example is go look up the how Instagram was created. Instagram is not what it is today. It was a way just to share photos and and like with some other features around it, and then now it's this global social network, and so yeah, it's really about the team than the actual business. And it's a combination of everything. And it's going to be different. I mean, I say that's the normal because sometimes you're going to have, it's such amazing tech or it's such an amazing idea. It's like service-wise or someone who's changing the way insurance is done, like whatever it is, that they're just like, we know this is going to be huge and we want to jump on. But most of the time is this team going to be able to lead them to it? And more importantly, and one thing we haven't mentioned about founders is you have to be coachable. If you're not coachable, they're not going to give you money because they know that there's going to be multiple times throughout that journey that they're going to have to come in and help you navigate certain ways. And if you don't have that coachability, then they're not going to be able to help you.
Hello? Yeah. Based on the market in Reading, do founders need to look at outside of Reading in order to even think about scale for venture capitalists at all? Maybe I'm thinking just like pre-revenue and thinking about the scale to get anyone even somewhat interested. Would they think they have to probably think outside of Reading, I'm thinking, because of the user base or...
I mean, it all depends on what you're trying to accomplish, right? And if you're talking something that you want to be national or global, then obviously you got to think outside of Reading and whatnot. If it's something where it's going to service this area or like Shasta County, maybe some of the surrounding counties, whatnot, then you might be able to find local, like, Shasta Angels, folks like that are willing to come in. I mean, it's different than actual venture capital. Angels have their own whole different perspective on how they invest, but and every angel group is going to be different. But yeah, it just depends on really what you're trying to achieve. But yeah, if you're trying to go statewide or national or even global, you're going to want to, you're going to probably be taking a lot of trips to Sand Hill Road and trying to talk to the venture capitalists down there.
Good thing we have flights from Reading down to San Francisco.
Yeah.
Whoa, plug for the airport. And I would say on the angel bit, sometimes there is a misnomer that because they're called angels, that means they're like, sure, take money.
No.
Here, there, have it. I don't want this money. Like, that's not what it means. They're looking for return, like ROI and return on their investment as well. So that's sometimes something we have to deal with. It's like, wait, they're not just going to hand over cash? It's like, what? Probably not. So just launch that in your brain.
Back to what he said about not having a good resume. You said find people that are successful in the industry you're wanting to be in and put them on your team or as advisors. Are you saying to try to have them be part of your business or basically just vouch for you to the investors that this is a good idea or they might be successful?
Yeah, so there's two ways. So the advisors are people they get incentivized to, basically they don't run your company day to day with you, but you might have weekly meetings or bi-weekly or monthly meetings with them where you go through the challenges of your business and what you're working on, and they've been in there before and they can guide you through those challenges. And then there's actually where you find people that want to come in and work the business, where they're actually typically a full-time, so working on it full-time or even part-time as someone who helps move the business forward. So that's the two ways that you want to do that. And
would you say that's kind of like a mentor?
Yeah, and look at an advisor like a mentor. Yeah. Okay. Yeah.
Thank you.
You're welcome.
So if raising funding from a venture capitalist is a relationship building project, can you give 1 to 3 ideas on how someone can meet and build a relationship with a venture capitalist?
Yeah, so the main one is like down in the Silicon Valley. It's just every day there's a networking event that you can go to for specific industries, whether it be like medical device or pharma or tech or AI or SaaS. I mean, there's all kinds of different events. And those VCs will typically be there that invest in that type of thing. That's a great way to go understand who the players are in your arena, and then understand, like, be able to walk up, shake their hand, learn about them. And the number one rule in relationships, as most of you probably know, is people love to talk about themselves more than they want to hear about you. So go up and just ask them really interesting questions. Like, hey, like, I understand you're a venture capitalist. Like, what's the coolest thing you've invested in lately? Or what are you really looking for? The other thing, too, is find out how to help them. Like, it sounds really weird, but the more you ask them questions and the more, sometimes you can just be like, hey, like, what are you looking for? In case I find it, I can send it to you. And then go do a little work and find it and send it to them. And they're going to, like, now your name comes to the top of the list because you're like, oh, that guy just went out and did some work for me, and he didn't expect anything. And don't expect anything. That's the other key, but that's one way to make that relationship.
One of the things that I also heard that I love is it's like when you ask for money, you get advice, but when you ask for advice, you get money.
Yes.
So throw that in there. And then, get the game. Let's get deep and be like, I have all these icebreaker questions for you. Okay. And then just like, go through them. You learn all about them. So I have about like 2 more questions left. If anyone has questions, now's the time to ask. Oh, we got 2. Perfect. Filled.
Do you ever see VCs fund manufacturing? Because obviously manufacturing doesn't have anywhere near the 10x returns of tech or AI or pharmaceuticals. I mean, they're pretty, because the expenses go up as sales go up. Do you ever see VCs invest in US-based manufacturing?
Yeah. And I mean, there's specific like VCs that invest particularly in manufacturing. It's just the type of manufacturing that they're looking to invest in. A lot of times they're looking for additional like differentiators of that manufacturing. Maybe they're employing certain types of tech that other manufacturers aren't, or they've come up with some way, or maybe they're just positioned to manufacture for an exploding market that no one else is there to provide the manufacturing for. And so like if you get some crazy like titanium phones, all right? And like nobody's there this is just coming up with something, but like, and you're the only manufacturer in the United States or the world that can manufacture like the titanium cases for those phones. VCs are going to line up to give you money because there's a huge demand and nobody to fulfill it from a manufacturing standpoint. So
I have a question kind of on the tail of that for a product. Like if you're going to be manufacturing a product, both how do you protect yourself from that product getting taken and somebody runs with it? Like, is it in the beginning of when you're pitching it to people, there's in those terms, there's like, okay, I'm signing privacy to this.
Are you talking to a physical product?
Yes, correct.
So that's what our patent system's designed for,
Okay.
is you're going to want to go get IP protection around that. Yeah. So if you develop one and need an infomercial, I know a guy.
But I heard on top of that, I heard from some investors that inventors that some of these patents are absolutely useless. They tweak it a little bit and then they get another patent on it.
Well, that's why you need a really good patent attorney. And the other thing about a patent I'll throw out there is a patent's only as good as it is defensible. And so you can go out and spend whatever it is, $20,000, $30,000, $40,000 to get a patent. But if you don't have any money to defend it, companies will rip it off all day and there's nothing you can do about it because you don't have any money to go fight them. So.
And then do you have anything, say we have like a petting zoo upstairs with like horses running around, I don't know. I think it's probably the theater program, and in all honesty, that's up there. But anyways, is there anything specific that you would say if there, like we have people all the time kind of with what was asked, like, oh, I don't want to talk about my product because someone's going to steal it. Like, do you have anything to say specifically to that?
Don't worry about that. Like 98% of the people in this world are lazy, and they're
Yep.
they're not going to go steal it anyways. They don't have the motivation to do it.
Yeah.
And so, I mean, you can talk about it all day long, and they'll be like, "Oh my God, I want to steal that," and then they're going to go get sidetracked and do something else the next day. So
That's great.
Can you repeat? You said there was a meet and greet in some location. I just missed that. A place to meet people and.
Well, I'm just saying, yeah, down in the Silicon Valley, there's all kinds of meet and greets and events where people meet venture capitalists. Meetup.com is a phenomenal place to find those. Yeah, Eventbrite is another one. Who I actually graduated college with the founder of Eventbrite.
Really?
Yeah.
That's cool.
She doesn't take my emails anymore, but I did.
What the heck?
I
Went
did
straight
walk
to her
the
head.
stage right before or after.
That's awesome. Well, thank you again, Tyler, so much for
Yeah.
coming up and spending your time with us. So super appreciate what you had to say.
I'm happy to be here. So
Yeah.
anytime.
Well, be careful when you say anytime, because I'm gonna be like, okay, so when can we pencil you in? Let me
Yeah,
get my
no,
planner
serious.
out. So
I always look. I'm born and raised here, so I always look for a reason to come here. My
Yeah.
parents are still here. So.
right? They'll like bribe us, be like, do it more. Like okay. So anyway, thank you again so much for coming out.
Yeah. And I will say one thing, because I know this was about venture capital, but the cheapest form of money is from your local bank. And so if you really want because when I heard everyone talking about their businesses here, a lot of them are not going to be venture funded, and probably most of them aren't going to be angel funded from a actual organized angels group. You might get friends and family or friends that are high net worth to give you seed money to do that, but your local bank and your bank's debt is literally the cheapest way to get funding for a business.
100%. We have some great banks that are geared toward business here, being like Cornerstone, 5 Star. Those are great business banks too, and there's some other ones as well. So we're gonna wrap it up. If you have questions, find Tyler afterwards. Yes. So with that, if you want, you can, unless you want to help me, wrap up this thing, and you can just see slides and go from there. But
No,
I got it from here. So you're released from the stage. So thank you again so much. Super appreciate it.